In this chapter, we'll develop the forecast business plan to cover the first 5 years of operations. We'll develop the forecast cost and income structure after considering varying scenarios and developing a break-even point. The cash flow we'll focus on is net cash flow to equity owner, since the assumed financing structure includes debt and equity. Then, we'll build the forecast balance sheet and give attention to the cash forecast. Lastly, we'll look at the liquidity ratio and the return on equity ratio. The cost and income structure of the new company is based on the sales forecast and the weighted development of historical fixed and variable expenses. Scenario analysis evaluates the impact on the firm's return of simultaneous changes in a number of variables. Here, we used a change in revenues. Fixed costs change by contract or inflation, while variable costs change with revenue. In the break-even scenario, we test to determine the level of revenue where net income would be zero given the assumed cost structure. Net cash flows to equity owners are shown excluding and then including officer compensation after tax. Return on equity in the new company is developed for the first 5 years in the forecast period. Based on the average sales per month in the historical period, we can develop a monthly sales forecast for year 1. Using the cost and income structure studies, we can develop net income. In this model, interest expense is recognized in the last week of each month. Based on the sales forecast, we can use the judgmental method to build the forecast balance sheet and project the inflows of cash from accounts receivable and outflows of cash to payables and expenses. Then we can include end-of-month cash outflows for financing and investing activities, including debt principal payments and fixed asset investments. Lastly, we can develop the ending cash balance and compare that to the target cash balance to identify a cash surplus or a cash deficit. In this chapter, we developed elements of a forecast business plan for the first 5 years of new company operations. From the sales forecast, we developed the cost and income structure in the forecast period. We considered the impact of a change in revenues, including a break-even scenario. Net cash flows to equity owners indicated the cash available to owners after operating needs have been met. Investments were made in fixed assets to keep the company healthy, and debt payments were made. We identified a return on equity in the assumed operating and capital structure. By using the judgmental method, we developed the forecast balance sheet to identify the impact of management practices for accounts receivable, inventory, and accounts payable. We illustrated the amount of liquidity in the company by identifying the ending cash balance and compared that to a target cash balance.
For more information, contact Rainier Business Intelligence.